Hi there, in this video I will continue talking about the equity method and the fair value method for the consolidation of two companies. If you remember, in the previous video we say if the parent company owns less than 20%, we use the fair value method or the cost method. If the parent company owns between 20 and 50%, then the parent company uses the equity method. If the parent company owns more than 50%, here we use consolidated financial statements, which we will discuss in the coming chapters. So now let us talk about the same example, which I ended by in the previous video, exercise 1. If you remember, on that example, we talked about Puma as a company who owned 40% of Sunny Company. And we made the journal entries for the purchase of stock, the recognition of net income, the declaration of dividends, and the collection of dividends. But there is one more point I need to add, which is the trademark. If you remember in the scenario here, the common stock fair value became $2,020,000. The book value is $1,870,000. And the land was undervalued by 136. And we say any difference happened between the market value of the company and the book value should be recorded in the trademark. So we need to know how to calculate the amount and how to record it. And this is what I'm going to show it to you here. First of all, we take the common stock fair market value of Sunny, which is $2,020,000. minus the book value of Sunny, $1,870,000, minus the undervalued land, 136. So the difference here will be 14,000. What is this difference? It's an income that should be recognized by Puma is the parent company. So how can we recognize it? Should we recognize the 14,000 in 1 year? Of course, the answer is no, because we need to divide it by 8 years. So the annual amortization of the trademark will be 1,750 for all the shareholders. But Puma owns only 40%. So now the amount that should Puma recognize is 700. So for this $700, we need to make a recognition of the income. So we debit equity in investee income and we credit investment in Sun. So when you do the exercise, you might see a similar example like this one. Please follow the same steps and you should get it right. In some examples, I ask for the amount only. In other exercises, we ask for the whole journal entry. Now let us go to another exercise, exercise 2, which is also talking about journal entry by a company called Sudo, which is the parent company that owns 40% of Sunflower, and this is the subsidiary company, for $982,000. And Sudo used equity method. The price paid $66,000 in excess of the book value of net assets. When I say net assets, I mean the equity, which is assets minus liabilities. Sudo agreed to make this extra payment because of the recently developed patent. In the previous example, it was trademark. So the trademark or the patent difference from one example to the other based on the scenario. The trademark was amortized over 8 years. Here, the patent should be amortized over 15 years. And all the other assets are the same. Then Sunflower declared and paid 100,000 dividends. And the net income, 392 and 358 in 2020 and 2021. On July 1st, 21, Sudo sold 10. So here, initially, Sudo purchased 40 and now sold 10. So still, Sudo recognized influence on the management of Sunflower which means pseudo should remain using the equity method. Although it solved this interest, pseudo maintained the ability to significantly influence sunflower decision-making, which means it should make equity method. And now again, we need to do the journal entries. I hope that now you can do it by yourself. So if you would like to stop my video at this point, get a piece of paper and try to do the journals similar to the previous example. And now here is the answer. The purchase of a stock is going to be the same. We debit investment in sunflower, credit cash. The recognition of the net income, also the same, debit investment in here it should be sunflower, and credit investee income. Then we debit dividends receivable, credit investment in sunflower, not sunny. And then the collection of dividends, we debit cash, credit dividends receivable. So almost the journal entries are the same, they don't change. And now let us go to another exercise. So in exercise 1 and 2, I was trying to show you how to make the journal entries. In exercise 3, how to compare the calculation of the two methods. So here you see a company called Big, and this company got 20% in Little, which is the subsidiary company. And in this exercise, we are asking to report the fair value method and the equity method, so we know the difference between the two methods in calculation, not in journal entries. So we make up this table. So here in 3 years, the subsidiary company, which is Little company, it made 200,000, 300, 400, and it's given here 200, 300, 400. So this information is taken from the examples. Then the Little company made dividends of 50, 100, 200, and we own 20%. So here we have 50,000 dividends declared by the company, then 100, 200, oops, sorry. Here you go, 50, 100, 200, and we need to calculate 20%. So from the 50, 20%, we get 10,000, from 100, 20,000, from 200, 40,000. So far, so good. But now we see that the fair market value of the shares, they go up. So here it says the fair value of Big investment in Little was determined by the market 245 in year 1, 282 in year 2, 325 in year 3. Now, when we bought the shares initially, it was 210. And now the value increased to 245. So what shall we do? We subtract 245 minus 210, we get 35. Then in the following year, the amount jumped to 282. If we subtract 282 minus 245, we get 37. In the third year, the fair value jumped to 325 minus 282, we get 43. So how do we get these numbers? Subtracting the market value of 1 year from the prior year. The next point is, how about the income? Here we see we have 50, 100, 200, and here is the market value. So here the company, when the influence, they have 40,000. What does it mean? It's the equity in the investee company, because if you remember here, they made income 200, 300, 400. From each one of these amounts, we recognize 20% if we have influence on the company. So 20%, it's a very critical percentage because we say less than 20% we use fair value, 20% and above we use equity value. So 20%, it's a very critical number. And when we get an example of 20%, we have to know whether we should use fair value or equity value. If the exercise doesn't mention, you are free to choose fair value because this is the general rule. But here we say we use 20% and we use equity method. So we take each one of those income multiplied by 20% and we get our amount. Finally, we get here the amount as a net, which is 200 plus 50,000, I'm sorry. Yep, 200 plus 50,000 minus 10,000, we get 240. Then we get the second one, we get 280, and the third year we get 320. So here we use the initial investment in this column plus the portion of the net income minus the portion of the dividends. Okay, so here, let me repeat it again. We get the amount of here 210 plus the income 40, 250 minus 10, we get 240. And in the same year, in the next year is going to be the increase and so on. Now, here are the journals as we did it in the prior examples. You debit investment, credit equity, debit dividends receivable, credit investment, and then debit cash, credit dividends receivable. Now, in exercise 4, we talk about something different because here we talk about ownership of 40%, and then we talk about difference in prices, and then here we have net income and dividends, and here we have the amount risen from certain amount in another one, and we need to recognize the equity method. So what do we need to do here? It's not journal entry, but recognizing the difference between the assets and the liability and the amortization. So here we purchase the shares in Sandy Company, 40% for $73,900, which is here. But the book value of Sandy Company is the assets $251,500 minus liability, we get the difference. From this difference, we calculate our percentage, which is 40%. Then we subtract it. We get this difference as a cost. So this is like a cost for us. Then the patent, which is increased in market value, 3,600, minus the book value of the patent, 8,100, get our percentage of ownership 40%, so we get 9,000, and this is like a benefit for us. If we subtract the cost minus the benefit, we get the difference, which is in the example is called goodwill. So remember the difference here, it could be trademark, it could be goodwill, it could be patent. It's mainly an intangible asset. And then we calculate the amortization over 6 years. If you remember in the prior example, it used to be 8 years or 15 years and so on. Now we need to see that the acquisition price here plus our portion of the net income minus our portion of the dividends minus the patent amortization, which you have seen it in the prior slide. And please remember that if we have ownership, we have significant ownership, we must do our calculation of the investment in the same way. And I believe you might see 2 or 3 examples in the assignment. It talks about the same calculation. You get the acquisition price plus your portion of net income minus the portion of dividends minus the patent or the goodwill or the trademark. You get your investment in Sandy. And this is the first part of the requirement, by the way. So in this exercise, the scenario looks similar to the prior exercises, but here I don't need to do the journal entries, but I need to do the calculation. In year 2021, I'm going to do the same, but I will start not by the acquisition price, but I will start by the investment that I ended by in 2020. And then we add the net income, subtract the dividends of 2021, subtract the patent, we end by the investment in 2021. In the assignment questions, he might ask about the investment here in 2020 and the investment in 2021. You do your calculation outside and you plug in the number and you should get the full amount. Now, the next example talks about downstream and upstream sales. What do we mean by downstream and upstream? These are the transactions that might happen between the parent company and the subsidiary company. If the parent company sold some inventory to the subsidiary, it goes from the investor to the investee. The transaction goes that way, we call it downstream sale. If the subsidiary made any sales of inventory to the parent, we call it upstream sales. So remember the difference between them, which is which direction the transaction is taking, parent to subsidiary or subsidiary to parent. And here's an example about this transaction. Picasso Incorporation holds 24% of Sierra outstanding shares, which means that we have significant ownership and we use equity method of accounting. The excess patent amortization, so here we calculated the difference between the fair value of the common stock, the book value of the common stock, the difference between them, amortize it per year, and we get the amount 11,200 to save you the time of calculating all the amortization amount. In 2020, Sierra reported earnings of 112 and declared the cash dividends 34, but, and here is a big but, in this example, Sierra, which is a subsidiary company, acquired inventory for 54, which is then sold to Picasso. So this continue, it's an upstream, so upward stream, which means here Sierra, the subsidiary, is making sales to Picasso, the parent company. At the end, Picasso continued to hold merchandise, which means out of this 90,000 inventory, 37 was still on the shelf and the difference has been paid. If the parent company doesn't sell all the inventory, by the end of the year, the parent company must do some adjustment to the remaining inventory, whether it's upstream or downstream. Now we need to know the equity in investee income, and consequently, we need to know how we calculate this difference. So here we start by the ending inventory, which is 37, and then the gross profit in this 37, how do we get it? If you remember, the selling price by Sierra was 90. The cost price by Sierra is 54. The difference between them is gross profit. We divide it by the selling price, we get 40%. So the profit in the ending inventory is 14,800. Now we have the ownership 24%. So we should take our ownership from 14,800. We get the gross profit difference. Why we call it different? Because this ending inventory will go to the next year. So we defer the recognition of this income until the next year. And you might see in the assignment as well, talking about the intra-company gross profit difference or intra-company transactions. You need to know which stream is it, downstream or upstream, and you need to know how to make the calculation. Then the net income of the Sierra company, 112 by ownership, 24%. The dividend, the difference here, 3,552, and the patent amortization, 11,200. We get the equity in Sierra, 12,120. So this is in brief tells you how to make the journal entries for corporation, either under fair value or under equity method. Remember how to do the journal entries and how to make the calculation. And if you need any help beside those videos, please reach out to me by email. We can have a Zoom meeting during my office hours and we can go through the exercises. Remember, you will have like 9 exercises in the assignment of this week. mainly talking about these issues. Feel free to read the textbook, do the exercises, and remember, I'm always one click away from you. Wish you a nice and successful week and hope to be in touch with you soon. Bye-bye.